Hey everyone, welcome back to Corporate Decoder. Today, Oak Associates Funds just filed their semi-annual shareholder report, and I am seeing a few trends that tell an interesting story about their funds. Quick note, this is not financial advice, just my take on public filings for educational purposes. These reports are dense, but they reveal how companies are managing investor money, and some of these numbers show an interesting strategy. This is a certified shareholder report for registered management investment companies. Think of it as a checkup for these investment funds, showing shareholders how their money has been managed over the last 6 months. We are looking at reports filed by Oak Associates Funds covering the period up to the 30th of April. 2026. The Securities and Exchange Commission, or SEC, is the government body that oversees these filings to make sure companies are transparent with investors. This is a unique identifier for the Oak Associates funds. It helps keep track of their regulatory filings. This is the main registrant, the umbrella company that manages several different investment funds. We will be diving into the performance and holdings of these individual funds. This tells us when their financial year closes, which is important for understanding the reporting periods. This is the end date of the 6-month period covered by this particular report. This is one of the individual funds we'll be looking at. As the name suggests, it focuses on companies in emerging technology. This confirms the report covers a half-year period for the Black Oak Fund. This section is about how much it cost investors to keep their money in this fund. For a hypothetical $10,000 invested in Class I shares, the costs for this 6-month period were $57. This is about 1.06% of the investment. It might not sound like much, but these fees add up over time and impact your overall returns. This gives us a look at the fund strategy by showing where the money is allocated. This is a big one. The Black Oak Emerging Technology Fund has a massive 77.1% of its assets in the technology sector. This means that the fund's performance is heavily tied to how well technology companies do. They're holding a small amount in cash and other assets, which is typical. The other sectors make up smaller portions of the portfolio. This confirms it is a highly concentrated bet on technology. This is the total value of the fund. For an emerging technology fund, $61 million is a moderate size. With only 28 holdings, this fund is quite concentrated. This means a few bad performers can really hurt the overall returns. This is the fee paid to the investment advisor. It is about 0.74% of the net assets, which is pretty standard for active funds. This number is quite low. A 7% turnover means they are not buying and selling stocks very often. This suggests a long-term investment approach which fits with a focus on emerging technology. This means the fund operated pretty much the same way it did in previous periods. No major shakeups. Next up is the Live Oak Health Sciences Fund. Unsurprisingly, this one focuses on the healthcare sector. For Class I shares, the costs were $52 on a $10,000 investment, or about 1.03%, very similar to the Black Oak Fund. This is almost a pure play on healthcare, with 96.8% of assets in this sector. It makes sense for a fund with this name. A small amount of cash. This fund is a bit smaller than the Black Oak Fund, with about $49 million in assets. Also quite concentrated with 29 holdings. High concentration can mean higher risk and potentially higher reward. Again, a standard advisory fee, an extremely low turnover of 3%. This fund managers are really taking a long-term buy and hold approach, which is common in healthcare where innovation cycles can be long. This fund, the Pin Oak Equity Fund, seems to have a broader investment strategy. Costs here are slightly lower at $48 or 0.93% for a $10,000 investment. This fund is much more diversified across sectors. Technology is still the largest component at 23.3%, but it is not the overwhelming majority, like in the Black Oak Fund. We see significant exposure to healthcare, financials, and communications too. This indicates a more balanced approach to growth investing. The remaining sectors fill out the portfolio. This is one of the larger funds with about $144 million in net assets. 31 holdings suggest a diversified equity approach, a higher advisory fee here. But that is expected given the larger asset base and more complex portfolio. A 10% turnover is still relatively low, pointing to that long-term investment philosophy across the board. As the name implies, this fund is heavily focused on technology. For Class I shares, costs are $46 for a $10,000 investment, or 0.89%, very efficient. This fund is also very concentrated in technology with 66.8%, but it is less so than the Black Oak Fund. The other significant allocations are in communications and consumer discretionary, which often tie into technology trends. This is the largest fund by a significant margin, with over $772 million in net assets. This large size could mean they are experiencing economies of scale, still quite concentrated with 29 holdings, despite the large asset base. This is the highest advisory fee in dollar terms, again due to the large asset size. A low turnover, reinforcing the idea of long-term investing in technology. This fund seems to be focused on finding undervalued or discovery type investments. The costs here are higher at $70 or 1.25% for a $10,000 investment. This is among the higher costs we've seen. This fund has a more balanced distribution. Technology is the largest at 43.1%, but industrials and financials are also significant. This suggests a strategy of looking across different sectors for opportunities. The remaining sectors are smaller parts of the portfolio. This is one of the smaller funds with around $15 million in net assets, a similar number of holdings to other funds, so still a concentrated approach. A smaller dollar amount for the advisory fee, reflecting the fund's size. A much higher turnover rate of 20% compared to other funds. This suggests a more active management style, which might be why the costs are a bit higher. This fund aims for core growth, likely a more stable, large cap focused strategy. Costs are 1.25%, similar to the River Oak Fund. Industrials are the largest sector here, followed by healthcare and financials. This seems like a strategy focused on established, growing companies. The other allocations are smaller. This is another smaller fund, around $12 million in net assets. Slightly more holdings at 34, suggesting a bit more diversification. This advisory fee is quite low in dollar terms, reflecting the fund size. A 13% turnover rate is moderate, fitting with a core growth strategy. This fund, White Oak Select Growth, appears to be a broad growth oriented fund. Costs are only $46 or 0.89%. Very efficient again. This fund is heavily weighted towards technology, communications, healthcare, and financials. This is a common mix for growth strategies. Consumer discretionary is also a significant part of the portfolio. This is the second largest fund with close to $477 million in net assets. 30 holdings indicates a concentrated approach, common across many of these funds. This is a significant dollar amount for advisory fees, reflecting the fund's size. A very low 5% turnover. This fund is definitely focused on long-term holdings. Now let's look at the financial statements to see how these funds are performing. This is where the real story often lies. Here is the detailed breakdown of what White Oak Select Growth Fund holds. They have significant holdings in a few big tech names like Alphabet. This is a large position valued at over $33 million, and a substantial amount in Amazon, over $45 million. These are the kinds of companies that drive growth in technology-heavy portfolios. The total value of common stocks for this fund is over $473 million, with a cost basis of about $182 million. This suggests a significant unrealized gain, which is a good sign for investors, assuming these investments continue to perform well. This is the balance sheet for the funds. It shows what each fund owns and owes. For White Oak, the investment securities are valued at nearly $497 million, significantly higher than their cost of around $205 million. That is a healthy unrealized gain. This confirms the net assets for White Oak are indeed around $477 million. Looking at Pinoak, their investments are valued at over $153 million compared to a cost of about $71 million. Another strong showing with significant unrealized gains. This matches the net assets figure we saw earlier for Pinoak. Rock Oak's investments are valued at over $15 million compared to a cost of just under $10 million. Good gains here too. This lines up with the previously reported net assets of about $12.8 million. River Oak's investments are valued around $17.2 million against a cost of roughly $11 million. Solid performance. This matches the net assets for River Oak. Red Oak's investments are valued at over $777 million, while their cost was around $206 million. This fund is showing massive unrealized gains, which is impressive for a tech-focused fund. This confirms the large net assets for Red Oak. Black Oak's investments are valued at about $66 million with a cost of nearly $29 million. Very strong unrealized gains here as well, showing the tech sector has been good to them. This confirms Black Oak's net assets. Live Oak's investments are valued around $51.9 million, up from a cost of about $27.7 million. The healthcare sector has also provided good returns. This matches the net assets for Live Oak. Now let's look at the income and expenses for each fund over the 6-month period. This is like the profit and loss statement. White Oak generated over $1 million in net investment income. That means after all expenses, the fund made money from its investments. They also had significant realized gains from selling investments, over $35 million, and the value of their holdings that they haven't sold yet, the unrealized gains, increased by over $12 million. Overall, the fund saw a net increase in its assets of nearly $50 million from its operations. That is a very strong performance for a 6-month period. Pinocchio had a smaller net investment income of about $193,000. But strong realized gains of over $20 million. This fund did experience some unrealized losses, meaning the value of holdings they still own went down by over $7 million. The diversified approach can sometimes lead to these mixed results in the short term. Despite the unrealized losses, the fund still managed to increase its net assets by over $12 million due to strong realized gains. Rock Oak actually had a small net investment loss of just over $4,000, but substantial realized gains of over $1.6 million, and a small unrealized loss of about $222,000. They are showing a net increase in assets from operations of about $1.4 million. River Oak had a net investment income of about $46,000. Very strong realized gains of over $6.8 million. This fund experienced a significant unrealized loss of over $2.8 million, which is the largest among the funds we've looked at so far. This could be due to some of their discovery investments not performing as expected in the short term. However, their strong realized gains helped them achieve an overall increase in net assets of over $4 million. The Red Oak Technology Fund posted a net investment loss of over $650,000. This is not uncommon for highly growth-oriented tech funds, as they often prioritize reinvestment and growth over immediate income. But their realized gains were massive, over $84 million. This shows how successful they've been at picking winning technology stocks. They did have a very large unrealized loss of over $36 million. This is a considerable amount and suggests that even some of their profitable companies might have seen a dip in value during this reporting period. Despite the combined investment and unrealized losses, their enormous realized gains led to a substantial increase in net assets of over $47 million. This is a testament to their strategy of generating significant profits from selling winning positions. The Black Oak Fund also had a net investment loss of about $140,000. Again, typical for a growth-focused tech fund. They had realized gains of over $10 million and a smaller unrealized loss of just over $1 million. They still managed to increase their net assets by a healthy $8.9 million. The Live Oak Fund had a positive net investment income of about $81,000 and strong realized gains of over $1.2 million. Healthcare has also seen good unrealized gains with an increase of over $1.7 million. This translated to an overall increase in net assets of over $3 million. Let's look at the financial highlights, which give us a per-share view of performance. These tables essentially summarize the fund's performance on a per-share basis over several years. This is where we can see consistency or major shifts. For White Oak, the net asset value per S-share started at $162.93. It grew by $17.51 per S-share over the 6 months. That is a solid gain, ending at $167.73 per S-share. Their net expenses were 0.89% of average net assets, which aligns with our earlier cost observations. They are doing a good job of keeping costs managed. The net investment income ratio was 0.48%. This means the fund is generating a small amount of income relative to its value. Pinocchio started the period at $95.07 per S-share. It increased by $8.36 per S-share, ending at $95.49 per S-share. Expenses here were 0.93%, slightly higher but still reasonable. Net investment income ratio was 0.27%. Rock Oak began at $21.73 per S-share. It grew by $2.57 per S-share, ending at $23.02 per S-share. Expenses here are higher at 1.25%. This is on the higher side and you really want to see strong performance to justify it. And they had a negative net investment income ratio, meaning they lost a bit of money on income relative to their assets. River Oak started the period at $19.22 per share. It grew by $4.93 per S-share, ending at $24.09 per S-share. Similar to Rock Oak, expenses are higher at 1.25%. However, they did have a positive net investment income ratio of 0.51%. Red Oak started at $59.55 per S-share. It grew by a very solid $3.81 per S-share, ending at $59.74 per S-half. Expenses are efficient at 0.89%. They had a slight net investment income loss of 0.18%. This is common for funds focused on aggressive growth where capital appreciation is the primary goal. Black Oak started at a low $9.97 per S-half. It grew by $1.47 per S-half, ending at $9.97 per S-half. This implies the fund's NAV did not change significantly in dollar terms, but the per share value increased due to more shares being issued perhaps or stable assets with a lower share price. Expenses are 1.06%, which is on the higher side for performance that looks somewhat flat in dollar terms, and a net investment income loss of 0.48%. Live Oak began at $23.24 per S-half. It grew by $1.33 per S-half, ending at $23.24 per S-half. Similar to Black Oak, the per share value is stable. Expenses are 1.03% and a positive net investment income ratio of 0.32%. Now for my take across these funds, we see a clear strategy at Oak Associates Funds. They are leaning heavily into growth, especially in technology and healthcare, with very concentrated portfolios. The lower portfolio turnover across most funds suggests a long-term conviction in their holdings. For the tech-focused funds like Red Oak and Black Oak, the immense unrealized losses combined with massive realized gains in Red Oak show the high-stakes game they're playing. They are making big bets and sometimes they win big, sometimes they eat some paper losses. Black Oak shows more modest gains in assets, but with higher expenses for its size, it is worth watching if that concentration pays off. The healthcare fund Live Oak appears to be a more stable player with consistent positive returns and unrealized gains, as expected in that sector, Pin Oak and Rock Oak. With their more diversified sector exposure, show a more balanced approach, though Rock Oak's higher expense ratio and negative net investment income ratio are areas to keep an eye on. The biggest risk I am watching is the high concentration in tech for some of these funds. If the tech market turns south, those large unrealized losses could become real losses very quickly. However, the consistently low turnover suggests the managers have high conviction in these companies long term. What I'm actually looking for is whether their concentrated bets continue to pay off consistently across all market cycles. The fact that they waive fees to stay within expense caps indicates they are mindful of investor costs, which is a good sign. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.